All right, so continuing with our liabilities, the company pays all expenses 50% in the current month and 50% in the following month. Well, that's then really simple. I'm just going to take the current expenses, which is going to be the sum of our expenses and cost of goods sold. And let's just put a sum in front of that times 0.5 as such. And let's just carry that forward. And I'm now going to write 50% of current month expenses. All right, then for deferred revenue, the products take 3 weeks to ship. So for that, I'm pretty much going to take 75% of our actual product sales and put that as this month's deferred revenue. And that makes sense because there are 4 weeks and they take 3 weeks to ship, which means 25% of the orders, or the orders in the first week, will go out that month. The remaining 3 weeks will go out in the following month. So in order to do that, I am just going to select the product sales times 0.75, and then I will drag it forward as such so that I have the deferred revenue balance. All right, and then the next one is going to be debt. The convertible note is at 5% interest, we know that. The note will convert in January 2025. Okay, well, if the note is going to convert, that means that we'll no longer have any amounts over here that will show in the principal. So first, I'm gonna set the accrued interest to be this month over here plus whatever we have in the actual drivers section for our interest expense on the P&L as such. Okay, so in this case, we need to showcase these amounts converting into equity, and that's going to convert into additional paid-in capital. So the total that will convert is 1,630,625. So let me just write that, plus 1,630,625. All right, and now I actually don't need either of these as such, and I'll just leave a note. Conversion. And let's just put a note here, conversion of principal plus accrued interest. Excellent. And then we can just put the actual driver is going to be 0 because we don't want to show anything in 2025. And then this is going to say convertible note balance. Excellent. Okay. All right, now let's read this last section. Investors will put an extra $1 million into the company in the form of additional paid-in capital in January 2025. Okay. Well, in that case, I'm just going to come back to this cell and add 1 million as such. And let's just edit this note. And I'll just say 1 million in equity contributions. All right, and let's just say convertible note balance and equity contributions. Okay, now everything else, I'm just going to say prior month. And then for this, I'm going to say that this is a formula because this, of course, is pulling directly from net income and our retained earnings balance. So that covers all of our balance sheet projections. Nicely done.